using price patterns to determine a likely correction or a reversal. When we're trading divergence, it's important to look at the price pattern when determining a reversal or correction. Now, obviously, we like to use price action over anything else. We believe price action is the most important technical indicator that we have of what is happening. Everything else is just supportive, including divergence. Okay, so we look for sharp wave cycles that break the high or the low between the divergent swings without a large correction to give us a probable reversal or at minimum another corrective cycle. So basically we look for price cycles to come in at least threes. So the sharper the cycle on the same degree, the more likely it is that it is a single cycle and it will correct and go into another cycle in that same direction. Okay, so cycles with a deep correction before testing that high or low are more likely to be a completed correction, and that decreases the probability of a successful trade. The exception to the rule is when the third swing extends 162% of the first two swings, measured by our Fibonacci expansion or projection tool. In this case, we will look for price to move into another high or low and label the cycle a 3 impulsive or a W for a double, like we're going to move into a double. We will also use Fibonacci trend time at times to measure third or C waves that extend 160% in time. Okay, and that's 162% in time of the A and B or the 1-2 waves. So you'll see sometimes where it'll almost look like you have an extension, or a price extension, I should say, when we actually don't. It's just that it's extended in time to where that swing, since it's extended so far in time in comparison to the initial two swings, that it appears visually to be an extension. And in many cases, those are waves that have extended 162% in time, and it's also a continuation sign, or it gives the probability of a continuation of that particular cycle. Okay, so we're going to look for this, and this is something else we're going to look for. We're going to show this in the chart, but this is something else we're going to look for when it comes to the objective divergence setup that we trade. We also want to use this particular method of qualifying those setups to give us a higher probability of success. Okay, so let's go ahead and have a look at a couple of divergences, and we'll give an example of both here so we know what to look for. Okay, this is already, we've showed this pair already before. This is just a recent pair on the dollar Swiss. Here we can see the divergence, price moving lower, MACD swinging higher here, and you can see the sharp rally. See how we have this really sharp rally right here. Okay, right here. That made the probability that this would move into another corrective cycle. Okay, so if we would have pulled back here initially, we were drawing our Fibonacci retracements on this particular cycle, and if we pulled back at that point, we'd look to buy this particular pair. Now, even here, after the market moved a little bit higher, kind of sideways and a little bit higher, we were okay with this because this didn't really pull back very far. So we were still looking at the probability that this would pull back and continue to the upside. Now, obviously it did. However, it didn't make a very deep pullback here for a trade. Obviously, we only traded to about the 38% right here. We did not pull back to the 50 to 62% zone, so we did not get a trade opportunity. Okay, but this is an example of seeing that sharp type of price rally that we want to see after the divergence to qualify the setup. This is an example of a divergence that we would not be interested in. All right, so we have price moving lower, MACD here is swinging higher. Now you see we have a rally, we have a setback right here that did stay above that low, by the way. Then we had another rally. Okay, so we broke the high. We broke the high, but we did it in a three-wave cycle. Okay, that's what we don't want to trade that. All right, we want to see that sharp price cycle. Now let me just go ahead and let me remove this. Another example where we did not want to buy this was right here. Okay, here we had another divergence. So we'll just draw this in. Price moving lower. Right here, our MACD was actually cycling higher. We had a divergence. And you can see we broke the high. We did break the high right here. But we didn't have a sharp rally to break the high. What happened? We had a three-wave corrective cycle, and then price continued to the downside. Okay, so while we broke the high between the divergence swings, that was the target of the correction. Okay, so when we already had a three-wave move that targeted the high point between the points that diverged, it makes the probability a lot less of a successful trade. All right, so I hope that makes sense. What we want to see instead is a sharp rally, then a corrective setback, because then the probability is we're going to see another leg of that cycle. Now, in this case, we have a divergence. We have a three-wave swing. Now, let's just draw the divergence in first. Here's price moving lower, MACD cycling higher. Okay, here's the high point between the points that diverged. Okay, now, in this case, we did see a three-wave rally. Okay, so we had a three-wave rally that moved through that high, but the major difference here is that this is an extension. Okay, so we measure from the high to the low, and let's go ahead and put on our 162%, and this cycle extended. Once we have that extension cycle, okay, we can mark this as what we call a bullish extension, and that is a bullish look. We are looking to buy the dips for a continued upcycle. This is when we're going to label this as a W or a 3 and look to project this to another high. Obviously, this was a better projection as a W, and then if we measured this from the high here, and let's just change this back to our regular equal legs 127, you can see that's right where we moved to. Okay, equal legs 127% of this initial price rally. Okay, so we labeled this as a W, X, Y, and this cycle extended as well, which would have kept us with a bullish outlook. And when I say that, let's look at the from this low to this high, pull this back, put our extension back on here. We extended through the 1618 with this cycle. So any pullback here, we were looking for price to continue to another high. Draw our Fibonacci retracement on the swing, get our 50 to 62% zone. Price retraced 50 to 62%, and off we went. Let's see if we had another extension here. This doesn't really look like an extension, but we'll just check it out anyway. Yeah, this didn't extend. So this cycle did not extend. However, we were already looking for price to move to a new high above this high point right here at 150.80. So this corrective setback would have also offered a buying opportunity. Okay, but you see how it all works together. While we're here, let's just go ahead and look at this correction. I told you guys I was going to give you so many examples that you wouldn't be able to deny it. So let's go ahead and just look at this correction. Let's measure it from the low to the high. And where did we hit? Equal legs 127. Equal legs 127, and then off we went. Now, in this situation, we had a nice confluence with the 62% in that equal legs level too. All right, so we had a confluence of reasons, plus we had a price resistance level over here. These are things you want to watch for. These are the trading zones we talk about. Okay, Okay, that offered a very nice trading zone right here, where we had the 62% Fibonacci retracement of this cycle. We had the equal legs 127 zone, and we had previous price resistance turn support when price came in here. Very nice level to watch for a buy opportunity. Okay, that was a trading zone we would set up and look for the long. And one more thing I see on this chart, I just love giving these examples. Look at the divergence here with price moving lower, MACD cycling higher. Look at this area. Look at where this high area was, and look where this cycle targeted. Even though we extended, look where it targeted. It targeted the high area of this larger divergence. Okay, this was the high points, the resistance level between these divergent swings, and that's right where this cycle went to. Folks are going to see all of these examples time after time after time every day in the market. Okay, so we'll watch the price patterns. We want to see those sharp rallies. We want to see the sharp rallies. Okay, not the ones that subdivide before testing the key level, or I should say the high point or low point between the swings that diverged. We want to see it break that level in a sharp manner, which gives us a higher probability that we are going to see a continuation of that cycle. If we do see a three-wave swing that subdivides, we want to see the 162 extension. So we want to see that third or C wave extend.